Hey guys, it's Kevin DaSilva here with the Living Los Angeles channel, and today we're meeting with Avo Momdjian for your Mortgage Minute. Avo, thank you so much for being on this call with me. I'm going to add you so that we're side by side.
Thanks
Welcome,
for
my
having
friend.
me, Kev. Always a
Always.
pleasure. Hey,
Hey man,
guys.
equally. I feel the same way. So I have you on this call because obviously, A, I'm not a lender. I help people buy and sell homes. I generate wealth in that fashion. But, it does go to say that overall in LA County, some 25 to 30% of sales are cash, and the rest of the people take a loan out on the property. And that's where you come in to help people realize the next chapter of their dreams, help build wealth through real estate. Um, and I value you're always on top of it. I mean, you have so many different loan programs, and that just makes you so essential and gives you such a better understanding of what's going on in the market. So, if you don't mind, I want to before we get into another topic, which is preparing for your home purchase this year or even early next year, I actually want to talk about where are we in the mortgage world?
So, the talk of the town lately is that interest rates are significantly higher than what we're used to during the pandemic, during 2020 and 2021. What we need to understand today is that we probably won't see those interest rates for a really long time. But one piece of good news that I can give is rates are starting to soften up now that the elections are out of the way. And we've seen a lot of movement in the stock market and 10-year treasury bonds, as well as the Federal Reserve as of late reducing their interest rates. So we're
Yeah.
definitely seeing interest rates soften up on our end and a lot more momentum on the buyer side.
I'm glad you brought that up. I actually have pulled up the historical interest rates since 1974. So let's talk about these rates since 2020. Obviously, when we look historically, I mean, our rates are back on par with 2001. And so we've had a blessing of over 20 years of these significantly lower rates. And we all know what happened, mid 2000 that led to that, and they had to do that to stimulate the economy to get out of the Great Recession. But we look back since 1982, we're not even half there. So it's something to take into consideration. When our parents were buying houses, these were the rates. Now the prices looked better then. That was a lot of money. But let's take a closer look since 2020. Now, obviously in 2020, to backstop the economy during a government forced shutdown, they brought their rate down to zero, and which brought mortgage rates down into the 2 range. Now, will we ever see that again? Like you said, at least not for a very long time, and probably in the 2s, maybe not ever again.
Absolutely, and it would definitely take another pandemic for us to see something like that. It would take
Oh, yeah.
another catastrophe, which we don't want, right? The last thing that we're worried about at that point in time are interest rates,
Yeah.
right?
Yeah, I mean, look at the Great Recession. 2008, they slashed interest rates. We bottomed out in 2011. We started to pry ourselves back up. The housing market was still very fickle. There was a lot of concern that we'd go back into recession. So 2011, I mean, the rates were bouncing in the very high 3s, low 4s. Somebody got elected. He decided to cut taxes. Federal Reserve had to raise interest rates to offset the growth in the economy, so we went back up towards 5. And then the pandemic hits, and bam, right? We're down here in the 3, and when you actually get over here, because you do miss a little bit, in the 2s, and then interest rates shoot back up because we have runaway inflation. But as you can see here, rates high, up here got up as high as 8, and then we've seen it come back down. And the last 2 Fed meetings, they've cut interest rates, which have seen rates come to their lowest point. So in September, we had 6.2. And we go back, when was the last time we had 6.2? Was May 2023. And the last time we were below 6.2 was actually September 2022. So We had a brief window where we saw some of the lowest rates in over 2 years,
Right.
But they've since picked back up, even though the Fed hasn't lowered interest rates. I'm curious, how does that work?
So the Fed rate doesn't directly correlate with mortgage interest rates as much as we think they do.
Yeah.
Mortgage interest rates are based heavily upon the 10-year Treasury bond. So the more funds that are put into the 10-year Treasury bond, meaning higher level investors such as hedge funds pumping in money into the 10-year Treasury bond, the lower we see interest rates go, because there's a larger supply of money in the bonds, right?
Okay. Where there's more demand, price goes up.
Exactly. Which is what we saw during the pandemic as well. The Fed was printing billions of dollars and pumping it into the 10-year Treasury bond, which is what we saw bring rates down. So it really depends on investor confidence in the 10-year Treasury bond. And there's a million different things that could affect mortgage rates. The stock market is another piece of that, right? If there's less confidence in the stock market, investors want to put their money somewhere that is much more secure, which they turn to the 10-year bond at that point.
Got it. So you're saying when more people are buying Treasury notes, they're offering lower interest rates, which then brings mortgage rates down because it's tied to the 10-year Treasury note. But when more people are investing in other assets, such as the stock market or mutual funds or whatever, and especially hedge funds who, kind of control a lot of the money, you're saying that when more people are investing in those, the interest rate they have to offer on the 10-year note to make it more lucrative goes up, and then that influences the mortgage rate. So right now what we're seeing is stock market's doing really well. A bunch of people are putting their money there. Everybody's feeling pretty good. And that's forcing the Treasury to offer a higher interest rate on the 10-year note, even though the Fed rate is lower, right?
Correct. And this is, again, not to say that the Fed rate doesn't have an impact. It's just not as big as we imagined.
Got it. Which, we are definitely seeing right here.
Exactly.
The rate was slashed 0.5%. And that got us to these ultra lows. And then ever since they slashed it 0.5%, they slashed it another 0.25%. We're back up to 7, which is on par with, earlier in the year.
Exactly. And that's also due to unemployment data being released out, where, unemployment rate went down. So we've seen a lot of push-pull, taking 2 steps forward, 1 step back.
I'm looking at another thing. And what's your take on the end of the year, like the home buying, situation, mortgage rates? Does it help maybe to wait for rates to come down some more? I don't know. What are you seeing?
Personally, I think it's a great time to purchase, especially towards the end of the year, because it's the time of year when we see the least amount of activity. Especially in a high interest rate environment. The one thing that should be on the top of each buyer's mind is not the rate, but the monthly payment. Real estate is, and I'm sure you can attest to this as well, Kev, it's an appreciating asset. And if you're able to get a good deal during these slow seasons, you're setting yourself up for success and avoiding the pitfalls of homeownership, where you buy high and sell low, right? It's the last thing that we all want to see. Where, going back to the pandemic, everyone offering $100,000, $200,000 over asking price. Some of them aren't seeing those appraised values today, right? So when there's more competition present in the market, you're going to have a high payment due to property taxes, higher down payment due to the purchase price that you're willing to offer. Whereas today, it's a much more relaxed environment. I'm sure you see that on your end as well.
Well, let me turn this around. I'll show you right now. Look, I'm a huge proponent of buy low, sell high, right? And, the emotions get the best of you because the reality is, we have a little bit of herd mentality to us. We like to buy when everybody else is buying. And it creates this scarcity mentality, especially in the spring when property values appreciate so much. You're like, oh my gosh, I'm not going to be able to afford this neighborhood anymore. So I get that part. And in some markets, like back in 2021, end of 2020, back in 2014, 2015, 2016, yeah, that was the case. Like if you didn't stop, if you didn't get in, at times you'd get out, you'd be done. Like you wouldn't even be, you'd have to look for a new neighborhood. Right. Now it's a little bit different. And as we can see here, homes take longer to sell. Look at this, January, the amount of days it takes for a home to sell in LA County goes up. And what are the odds of that? Every single year, except for, this was a pandemic. Right. We were on government forced lockdown, and yeah, homes did take a while to sell. Partly also because they weren't even giving mortgages sometimes.
Correct.
That said, I mean, here we're back in that same look. We're in the same cycle. So it's end of year. What happened? Why do homes take longer to sell? It's because there are fewer buyers looking for them, and so buyers get softer on the price. If you're not in as much competition, what are you going to do? You're going to be a little pickier, right?
Absolutely.
You get to expand on your decision-making process and timeline, and that plays out in the market every year. Here, let me show you this one. And so it's not a coincidence that we have a little bump up in prices when when we look at the interest rates. Interest rates had gone down. Prices went up, so as soon as interest rates come down, buyers are going to get, and it actually stopped what is usually a lowering, from every, you see the market bottom out every time.
Right.
2021 is a little bit of an oddball, still a little soft here, but I mean, 2021 was giving away 2% mortgages. This is what's going to happen. Exactly. It still took longer for homes to sell, and you still had the little dip in December, January, but they started to raise interest rates, and so people got in real quick. You know what I mean?
Right.
Yeah, I mean, look, even in 2020, when they first took rates, rates came down here. These were some of the lowest interest rates, and look at this. Still dips over the holidays. So, yeah, I mean, look, at the end of the day, I think we're in agreement. This is the time of year where if you're looking to pick up a deal, you should pull the trigger on it. But if you want to pay a higher price in spring, go for it, right? I mean, you can always refi in spring. But
exactly.
Yeah, but if the rates come down, you can always refi your lower purchase price. But unfortunately, you can't. If you don't own the house, then you're just going to have to purchase at that higher price, right?
I always say marry the price, date the rate. Refinancing does reset the clock, but in a high interest rate environment, we always see circumstances where you gradually refinance each time there's a dip. One thing that we offer to all of our clients, our past purchase clients, is a free refinance. So you have nothing to lose with that refinance.
Oh, wow.
We cover all of the hard costs of the transaction, such as escrow, title, appraisal. The only thing the client's responsible for are taxes and prorated interest, which are costs they would have otherwise.
Yeah, it's costs they would be paying anyway.
Exactly.
You're not going to pay the property taxes for that. Okay. So best time of the year to buy is right now. What should somebody be doing if they want to prepare for their next home purchase?
So I'm a big believer in keeping yourself lean, as lean as possible. And what I mean by that is try to minimize your liabilities as much as you possibly can.
Okay.
95% of the approval process is purely based off of debt to income ratio. And general rule of thumb is if the mortgage payment plus all of your monthly liabilities is less than 50% of your monthly income, you qualify, right? So keep yourself as lean as possible. Credit and down payment. I always try to motivate my clients to have as high of a possible credit score because it ultimately gets them the lowest possible interest rate. But it's not a big proponent of the approval process itself. Because there's alternative programs available to borrowers with lower credit scores such as FHA that help promote homeownership and help keep their interest rates low. Because it's a government insured product, the lenders feel a lot safer with that program and offer ultimately lower interest rates available to consumers.
Got it. Okay. So it sounds like the main thing is to keep your liabilities down, because your mortgage payment plus any of your other liabilities have to be below 50% at most, right? Or is there a little bit of wiggle room in FHA?
So with FHA, it's a two-part system. So FHA has a front-end debt-to-income ratio of 47%, which is just the mortgage payment and property taxes, insurance, right? So let's say, for example, your total monthly payment comes out to $5,000, right? You have to, that $5,000 has to be 47% of your monthly income. Their back-end debt-to-income ratio, which is the mortgage payment plus all other liabilities, is 55%. So it's a little bit over that 50% mark, right?
Okay. So like, let's say I make $10,000 a month, and so my mortgage can be plus interest, principal, interest, taxes, and insurance can be $4,700 a month. But I can actually have another $800 a month. Let's say I own a car and I pay $750 on it. I would still qualify for that loan.
Exactly.
Right?
Exactly.
Cool.
And another recommendation coming to the year end, let's say you're not ready to quite pull the trigger yet on a home purchase. One thing that I would recommend going into the new year for all of your self-employed clients is discuss your home ownership goals and financing needs with a mortgage lender prior to filing your taxes. Once you file taxes, it's hard to amend them. It takes a very long time. So I'd always
raise a red flag or two.
That as well. But I'd always recommend consulting with a mortgage advisor before you pull the trigger on filing your taxes, if you have that goal in mind of purchasing a home in 2025.
Got it. So just to recap, keep your liabilities low. Work on your credit score. It does help with your interest rate, which can help lower your mortgage payment. But you could always increase your interest rate refi later, right?
Correct.
Yeah. So just like you could always buy cheaper and refi later when rates come down rather than pay more money, as we saw right here, rates dipped to their lowest point in 2 years and the market bounced back up.
Correct.
Right? So you could have bought right here with a better rate and actually been, or even purchased here. Oh, that's a higher price. But you could have purchased here with a lower price and a better rate in this situation. But like, if you had bought here, rates were actually higher at this point. You could have refied here, and look at that. It's almost up. You would have, you would be paying some portion of $90,000 more.
Absolutely. I mean, as we speak, we had a small window of time where rates dipped down into the low sixes.
Yeah.
And a lot of my clients just from 8 months ago, 9 months ago, are capitalizing on over 1% in savings, through their refinance.
Big deal. I mean, that's a vacation right there.
Exactly.
or a new car, or nothing. That could be your retirement. Like it's just your future you. I don't need to work till I'm 90.
Exactly. It could be, more contributions towards their IRA, their 401k. It could be, like you said, a new car, right? Or it could be paying down your principal balance a lot faster.
Yeah. Sweet. Well, thank you for being on the show today, and I always appreciate you being here.
Likewise, Kev.
Let's do this again around the holidays and make our projections for the year.
Absolutely. Always a pleasure. Thank you for having me, and everyone, happy holidays. Wishing you guys the best.
Thank you. And if you want to see more of these interviews, more community highlights, hit the subscribe button, turn on your notifications so you're the first one to see every time we publish a video.